Dead things do not climb. Silver has spent this stretch doing exactly what a corpse cannot do. Rising, pressing against the ceiling of a base it has been carving out for longer than some of the people writing its obituary have been alive. And the same financial channels that ignored it the whole way down are still calling it dead money on the way up. If that contradiction bothers you, good. It should. Because the gap between what silver is actually doing and what they keep saying it is doing is where this entire story lives. If you are holding silver inside a retirement account right now, or kicking yourself because you think you already missed it, I am not going to make you wait for the answer the title promised. Here it is, plain. They call silver dead because they are reading the wrong clock. The dead money label was earned during the longest sleep any major market has ever taken. And a market that slept that long, then stood up and started walking, is not dead. It is the opposite of dead. It is a market that just finished the largest accumulation phase in financial history, and the people repeating the old label have not looked up from their script long enough to notice. By the end of this video, you will understand exactly why the length of that sleep is the size of this case. And near the close, I will give you the one practical principle that decides whether a holder actually survives long enough to benefit from it. Here is the concrete fact everything else in this video hangs on. Silver set a high in 1980, and then it spent roughly 45 years, trading beneath that old peak before finally pushing through. Think about what else was happening across those decades. Stocks made new highs over and over. Gold broke its own old ceiling and kept going. Oil, copper, real estate, everything cycled up and out. Silver alone sat below a level it had already touched year after year, through recessions and booms and 3 generations of investors, building the longest consolidation any major market has ever recorded. In my years in the gold and silver world, I have studied a lot of long bases. There is nothing else like this one, nothing even close. I want you to meet someone, because this story needs a human being in it, and she is more like you than any banker on television. She is a retired county librarian from Topeka, Kansas. She spent her working life in the periodicals room, threading microfilm of old newspapers onto the reader for high school kids doing history projects. And she will tell you something she learned from 4 decades of handling old front pages. The headlines are almost always wrong at the turning points. She has scrolled through the papers from 1980, when silver was the mania, on every front page. And she has scrolled through the decades after, when it disappeared from the news entirely. Now she has a modest position in her retirement account. She watches it climbing, and she reads the financial press still filing silver under dead money. And her librarian instincts are telling her she has seen this exact mismatch before, on film, at every major turn the archive holds. So let us do what she would do and go back to the source material. What ended silver in 1980 was a genuine mania, and manias have a look. Lines wrapped around coin shops. Families digging serving trays and candlesticks out of the china cabinet to melt them down. The price gapping higher day after day while leveraged speculators, the kind who can be broken on a margin call, piled in at the top. That is what a blow-off looks like, and when it broke completely. What followed was not a correction. It was a burial. The metal fell so far and stayed down so long that an entire generation of financial professionals built their careers never once having seen silver in a bull market. The dead money label was not analysis. It was autobiography. They had simply never lived through anything else. But here is where it gets interesting, because you have to ask what a 45-year base actually does to a market. A base that long is a transfer of ownership. Every impatient holder, every speculator, every fund manager who needed performance this quarter, all of them gave up somewhere inside those decades and sold. And every ounce they sold was bought by someone with no deadline at all. That is the mechanism the dead money crowd never explains. The longer a market sleeps, the more completely its supply moves from weak hands into strong ones, until almost nobody left holding it can be shaken out. I have watched this pattern play out in smaller markets more than once. The length of the base tells you how few sellers remain above it. 45 years is not a weakness in the silver story. 45 years is the story. And ask yourself who benefits from you believing the label instead of the chart. The trading desks at the big banks earn their living on your churn, on you buying excitement and selling fear over and over. A metal that embarrassed everyone who touched it for 4 decades is a cheap punchline for the financial media, and a convenient one, because a retiree who has been trained to smirk at silver will never ask why the ratio between gold and silver is stretched to levels history says do not last. The label is not there to inform you. It is there to keep you from looking. Now look at what the label is covering up, starting with supply. The world has now consumed more silver than it produced for multiple years running, a structural shortfall, year after year, deep enough that the above-ground stockpiles that used to cushion the market have been drawn down hard. And here is the twist that makes silver unlike nearly everything else on a commodity screen. Most of it does not even come out of silver mines. It comes out of the ground as a side effect of mining copper, zinc, and lead, which means when the silver price rises, miners cannot simply flip a switch and produce more of it. Supply barely answers price. Meanwhile, the demand side eats its inventory alive. The silver that goes into electronics and solar panels is scattered across millions of devices in quantities too small to ever recover. Gold gets locked in vaults and stays there. Silver gets used up and thrown away. A deficit in a metal that is consumed rather than kept from mines that cannot respond. That is the physical reality underneath the dead money joke. And that is not even the biggest piece. The biggest piece is gold, because gold is the tell. Gold has already broken out. It is pressing record territory, up in the low to mid 4,000s, while silver, working around the low 60s, is still lagging that move, which means the gap between them, the gold-silver ratio, is stretched far above anything the long sweep of history treats as normal. When this country first defined its money in 1792, the law set silver to gold at roughly 15 to 1. At the 1980 peak, the market priced it near 17 to 1. In recent times, it has taken multiples of that. At the panic extreme a few years back, well over 100 ounces of silver to buy 1 ounce of gold. And even after silver's recent catching up, the ratio sits far above every historical anchor. Here is why that matters to you. In the great precious metals cycle of the 1970s, silver lagged gold for years, exactly as it is lagging gold in this cycle. And then, in the final stretch, it compressed that entire gap in a fraction of the time, doing in months what gold had done in years. The lag is not evidence silver is broken. The lag is the coiled spring. And if you were sitting there with a serious retirement account thinking, fine, but what am I supposed to do with that? This is the moment I want to talk to you directly. That stretched ratio is exactly why my family put together the free Retirement Wealth Protection Guide. It walks you through how American retirees are diversifying a portion of their retirement savings into physical gold and silver inside the account they already have through a self-directed precious metals IRA, without taxes and without penalties, so you can actually act on a setup like this instead of just hearing about it. This is not just for insiders or the wealthy. If you have $100,000 or more in a 401k or an IRA, this is for you. And it comes from our family to yours. No obligation, nothing to buy. If you are watching this on your TV, just scan the QR code on your screen. If you're on your phone or your computer, go to readfamilyguide.com. Get the guide, and then stay with me, because the next part is the history nobody replays for you. Because silver being insulted while it rises is not new. Gold lived the same story. Through the 2000s, gold climbed from around $250 an ounce to nearly $1,900, a rise of roughly 7 times. And for most of that decade, the mainstream press and the big Wall Street houses treated it as a fringe obsession, barely worth covering. The greatest decade in gold's modern life happened in near silence. Being called dead, being ignored, being smirked at, that is not what the end of a move sounds like. In my experience, it is what the early and middle innings sound like, every single time. The applause only ever shows up for the final act. But here is where it gets strange, because the deepest force under this market is not mining deficits or ratios at all. It is policy, and policy can move metal overnight without a single interest rate changing. In 1933, the United States government simply outlawed the private holding of monetary gold, and the following year it revalued gold from around $21 to $35, a devaluation of the dollar by decree, executed between one sunset and the next. In 1971, Washington cut the dollar's last tie to gold and called it temporary. It was never reversed. In 1985, the major governments of the world met at the Plaza Hotel and agreed, on purpose, to walk the dollar down, and gold rose substantially in the years that followed without the Fed lifting a finger. This is the pattern the dead money crowd never studies. Precious metals do not need permission from interest rates. They need only a government that finds its debts easier to inflate than to pay. Which brings us to the present arithmetic, and it is brutal in a way almost nobody on television will say out loud. The last time inflation truly threatened this country, the Fed under Paul Volcker broke it, and broke gold's run, with punishing double-digit rates that stood far above inflation for an extended stretch. Run those numbers against the national debt as it stands now, with federal interest costs having recently grown larger than the entire defense budget, And the honest conclusion is that the Volcker medicine is arithmetically off the table. The interest bill alone would swallow the budget. Meanwhile, the Fed itself, under its current chairman, has been openly divided. Policymakers publicly split on which direction policy should even lean. I do not know what they will decide, and neither does anyone else. But I know what the arithmetic permits, and it does not permit the one thing that has ever truly broken a precious metal cycle. Now watch what happens when you follow the metal itself instead of the headlines. Because the physical market has already told us, at least once, exactly what it thinks paper promises are worth. During the panic of 2020, the price of gold in New York futures tore violently away from the price of physical metal in London. Planes were chartered. Vaults scrambled. Refiners could not keep up. For a brief, clarifying moment, the world was shown that a paper claim on metal and the metal itself are not the same thing, and that in a real emergency, the paper trades at a discount to the real. Silver's paper market carries that same structure at far greater scale. Many more claims outstanding than ounces available to deliver, with a handful of large banks holding heavily concentrated short positions on the COMEX. And in the positioning data, the fast money, the funds that chase whatever gold headline printed most recently, keeps crowding one way, while the commercial players who handle actual metal quietly accumulate the other. You do not have to predict the day that structure gets tested. You only have to notice who is standing on which side of it. Now let me give you the honest part, because you deserve the caution before you deserve the case. Silver is violent. In 2011, the exchange raised margin requirements several times in quick succession, and the price fell by roughly a third in a matter of days. Nothing about the physical world changed, and holders were carried out on stretchers anyway. In 2013, the mere hint that the Fed might slow its bond buying knocked gold down by more than a quarter. Shakeouts like those are not a possibility in this market. They are a certainty, and I will not pretend to know their timing. I cannot tell you where the price goes next month. I will not promise you a number, and nothing I say here is personal financial advice. What I can tell you is what 45 years of base building did to the foundation under this market, and that foundation does not disappear because the price has a terrifying week. The case is real. The ride will not be smooth. Both of those things are true at once, and anyone who only tells you one of them is selling something. Our librarian in Topeka understands this better than most professionals, and she gets it from her old job. Archives taught her a discipline. You do not judge a document by the week it was written. You judge it by whether it survives the decades. So she sized her silver the way she would shelve a rare volume, carefully, as a portion of her savings. Never so much that one ugly month could force her to sell it at the worst possible moment. That is the practical principle I promised you at the start. And it is the difference between the people history rewards and the people history uses as liquidity. Own it in a size you can hold through the shakeouts. Own the real metal and not just a paper promise. And never let fear sell your position into the bottom of a dip. The 45-year base rewarded exactly one kind of person, the kind who could not be shaken out. Be that kind. And if you want to know how the most sophisticated money on earth is voting, stop listening to what banks say and watch what their governments do. Central banks have been absorbing gold at a pace of over 1,000 tons a year for several years running, roughly twice the rhythm of the decade before, and that accumulation accelerated sharply after the world watched a major nation's reserves get frozen by decree. Every central banker on earth absorbed the same lesson at the same moment. A reserve held in someone else's currency is a promise someone else can break, and metal in your own vault is a promise no one has to keep. Gold has since climbed past the euro to become the second largest reserve asset on the planet. The institutions that print the world's money have quietly rebuilt their foundations on the one asset that is not someone's liability. They do not call it dead. They call it reserves. So here is the recognition moment, and I want to put it in our librarian's language. In her periodicals room, she could always tell what mattered by a simple rule. By the time a story made the front page, the people who profited from it had already read it in the footnotes years earlier. That is precisely where silver sits. The central banks are positioned, the commercial players are positioned. The physical market is tight and getting tighter, and the mainstream, the pension funds, the brokerage models, the evening financial shows, still have precious metals penciled in at a historically tiny sliver of their portfolios, still filing silver under dead. There is a window between the footnote and the front page, and that window is where the patient do their quiet work. Once the smirking stops, once the same channels that buried this metal start breathlessly covering it, the discount you are being offered for enduring the ridicule will be gone. The insult in the title of this video is not an obstacle to the opportunity. The insult is the opportunity. Which is why I want to leave you with something more important than a market call: what you have built and who it is for. If you have spent a lifetime filling a 401k or an IRA, through the layoffs, through the crashes, through every year you paid yourself last, then this is not really about silver. It is about whether what you built survives intact to reach your children and your grandchildren, in a world where the arithmetic of the debt keeps quietly deciding what a dollar is worth. That is exactly what the free Retirement Wealth Protection Guide was made for. It shows you step by step how to protect and diversify a portion of your hard-earned wealth and the inheritance attached to it with physical gold and silver inside the retirement account you already have, without taxes or penalties. It is completely free, from our family to yours. No obligation, nothing to buy. And if you have $100,000 or more in your retirement accounts, and you mention that you watched this full video, you will also receive a free one-on-one educational web conference where a real person walks you through your questions. Education, not a sales pitch. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. And the honest reason to do it now rather than someday: the calm stretches, when nothing feels urgent, are the only stretches in which repositioning is cheap and unhurried. Every archive our librarian ever kept says the same thing. The people who acted before the front page were the ones the front page was eventually written about. Dead things do not climb. Somewhere in Topeka, a retired librarian who spent her career watching headlines age badly is holding a medal that just woke up from the longest sleep any market has ever slept. And she is not waiting for the papers to correct themselves, because she knows from 40 years of microfilm that they always correct themselves last. The obituary they keep running for silver was written for a market that no longer exists. Let them keep running it. You have seen the base. You have seen the ratio. You have seen who is buying and who is laughing. And you now know that the laughter is the sound a turning point makes. From our family to yours, protect what you built. Hold it in a size you can keep. And let the front page catch up to you for once.